Hi, good evening, and welcome to this next in the series of Voicecasts by Sundaram Mutual Fund. Thank you for the overwhelming response on our previous Voicecast. We've had more than 100,000 views on both our EMI, E.M.I, that was the basic primer on the economy, markets, and investments, as well as the one we did on international equities and our global brand fund. Thanks for the phenomenal response. I hope all of you enjoyed it and they were educative. And the response for the promos on this one have also been phenomenal, right? So thank you all, and I'm sure all of you are as excited as I am to know what this is that we are going to talk about. So I've started sharing the screen of my presentation, and as you can see on the screen, this webinar is on an anti-mutual fund, right? Now, when we send out the promos saying anti-mutual fund, a lot of people had a lot of different opinions and views, and we could see that from the feedback you got. So they asked me, are you going to talk against the mutual fund industry? I know anti-mutual fund, because mutual fund is a word used for the industry for specific schemes and everything. So that's why I said, okay, let me in the title tell you that this is not about an anti-mutual fund industry piece. This is in fact about a mutual fund scheme, right? So it is a product webinar. Let me give you a heads up on that. It's a product webinar on one of our key products, which we are very gung-ho and excited about, number one. So we are calling this product obviously an anti-mutual fund, right? So that's why this is a webinar on an anti-mutual fund. So what is this anti-mutual fund? Because the phrase anti-mutual fund, like I said, throws up a lot of thoughts in your mind. So as we move on, so what is an anti-mutual fund? So an anti-mutual fund is an antithesis of a conventional mutual fund, right? So going forward, I don't want to keep saying anti-mutual fund, conventional mutual fund. So I'm going to use the abbreviations which are given on the screen, an AMF for the anti-mutual fund and a CMF for a conventional mutual fund. So I've given away part of my secret here in the sense that what I mean by anti-mutual fund is that, is it a mutual fund? Now that's the other doubt, right? When you say anti-mutual fund, then there are products like PMS, AIFs, structured products. So are we going to talk about that? No, bilkul nahi. This is about a mutual fund, and what's more, it's about an equity mutual fund. So let me get all the other doubts out of the place. So this is about an equity mutual fund, right? So then what is this all anti all about, right? Anti is that it is different in many ways from a conventional equity mutual fund. As I said, different is the key word, and in many ways is another key word. So first of all, before we go into what's different, let's look at what's not different, because ultimately it's a mutual fund, right? So it has to share some of the features of a mutual fund. So it's not like everything is anti-anti. So there is a significant piece which is not different between an AMF and a CMF. So to understand that, let's first evaluate what any mutual fund, MF, is intended to deliver, right? The raison d'etre of mutual funds, what are they there for? They are there to deliver value from the stock market, right? So a little bit of a primer on the stock market, right? Because see, I'm assuming that I'm going to have a range of participants today because it's open to public over YouTube, Twitter, Facebook. So you're going to have first-time investors, you're going to have experienced investors, analysts, distribution partners of ours, advisors, everybody, right? So pardon me, but I'm going to take you through what is a primer which will cover it, because I need to do that to really get to the nub of the thing. So the stock market, which is what mutual fund try to derive returns for you from, delivers through a two-pronged process. The first is that the companies in the stock market, their earnings, right, they grow. And as an investor, you can share in that growth. How? This EPS, that is the earnings per share, is passed on to you in the form of dividends, and they pay out dividends. So you directly get the return in terms of dividends. And there is the growth in the EPS which goes into the net worth of the company, the retained earnings it's called. So out of a certain X amount of profit, certain amount is paid out as dividends, certain amount is kept in the business for financing the future expansion, right? But that adds to the book value, the net worth of the company, which in turn reflects in the market cap. So whether a company pays dividend or keeps it for developing its business, the market has different valuation processes, but bear in mind that the earnings growth delivers value to equity investors, one. But there's a second important factor which delivers returns to investors. What I mean by that is that even if earnings doesn't grow, you still can get returns from the stock market because of what is known as the valuation otherwise known in industry jargon as PE. PE is price equity ratio, right? So the current price divided by the earnings per share. Now there is something called a trailing PE, which divides it by last year's earnings per share. And then there's a forward PE, where you take the expected earnings per share for next year, the year after, and call it the forward. The PE that I refer to here is the forward PE. Let me clarify, because what is already delivered as earnings is higher in the top line there, earnings growth. So that's not a very value in valuation. So the historic PE or the trailing PE is merely for the textbooks. Okay. So this forward PE, that rating going upwards. So you buy something, let's say I take an orbit number, you buy something at a 10 PE today, and tomorrow the PE of that stock goes to 12 PE, that means you got 12 divided by 10 minus 1, a 20% return purely, even if the E part of it has not changed. So the valuation rating upwards, how does that happen? One, the future earnings growth expectations, which the market participant tried to guess or analyze or project. There are various models for doing that, right? You have the discounted cash flow model, you have the growth model. So there are a lot of methodologies to determine future earnings growth, but the expectation of the market, so a high growth company will have a high PE ratio, right? So that's one thing, that the future earnings growth. So the company may not have been doing well in the past, but if your future is great, which is they've just done a tie-up, they've got a big order from a big company, so the future earnings going to go, their share price will go up, and you make money from that increase. The second is demand for stocks versus alternatives. What are alternatives? Bank fixed deposits, gold, other debt mutual funds, right? Whole bunch of things competes for customers, provident fund, mutual fund. Everybody's money is in a competition space, and how the demand for stocks. So sometimes you have future earnings growth expectations which are not great, but there's a huge amount of money chasing the stocks because the alternatives are not giving any great return. It's somewhat of a situation of today's scenario and the COVID scenario, where the COVID has put the earnings estimates down for all sectors almost. So there is no great earnings growth situation, but you're saying the stock market is rising every other day. That's because there's enough liquidity. There's a demand for stocks, which is driving the price. So please understand this basics of stock market returns, right? Which is very key to understand what this fund is going to be trying to do. So in this milieu of a stock market delivering returns comes in a mutual fund. Now, how does the mutual fund attempt to deliver? First of all, obviously, it goes and buys those stocks. So the same logic that was there in the previous, the mutual fund hopes to benefit from all the three, which is to go back to the previous slide. It benefits from the earnings growth. It benefits from the earnings growth expectation, which is what the fund management team and their analysts try and predict and use various models to predict. Think of the demand for stocks, which is if customers like you give money to the mutual funds, we have a lot of money to buy mutual funds, so we go and buy. So the awareness of the money flow in the market, because I'm an ex-mutual fund, Y mutual fund could get money, LIC could be an investor, foreign hedge funds could be, FIS could be investing. So judging that, right? So that's the job of a mutual fund, analyze that. And what do they do here? Because the stock market has about what? The BSE 500 has 500 stocks. There are 20, 25 sectors in the market, right? So what the fund managers try to do, because we all know, right, from the next slide, that a stock market is a volatile creature. Why is it volatile? The volatility comes because earnings growth declines, like today we are seeing. Valuation grows downwards because future earnings are also declining. And if there is falling demand for stocks, if people are risk off, as they say, because equity market is a risky market, right? Let's know that first. So if people are saying, no, I don't want to take risk at this point of time, I'd rather put a money in a safe bank deposit or a government security, then you will have demand. So equity market goes through these phases of volatility. So the mutual funds attempt to deliver better performance, please read the slide, through diversifying across sectors and stocks, because the factors that I mentioned, right, either in terms of up ratings, which are there in this slide, or in terms of down ratings on this slide, does not affect all sectors and all stocks equally. Sometimes, like today, you take it, right? Now you take it, consumption stocks are expected to revive quickly. Whereas there are certain other commodity stocks because the world is going to deliver. So predicting this is one way to manage, but diversification is one way to say, I don't want to take a big risk. I'll put a little bit of money in a lot of sectors, in a lot of stocks, so that the risk of one not delivering doesn't hurt my overall performance. So the fundamental ethos of a conventional mutual fund is diversification across sectors and across stocks. But the second aspect that to do is to judge these things, right? Is what things? That is the earning growth expectation. How do you come up with these expectations, right? You have to do your research. That is where the expertise in saying market is expecting this stock or this sector to deliver this kind of an earnings growth in future. However, my analysis says that either it's going to be delivering better, in which case I buy more of it, because sooner or later the market will discover that information which I have, and I will benefit from. Then when they come to know that news, they will raise the stock price up. So can you understand this very clearly? That is, understanding expertise comes because you should be able to, and the reverse is also true, friends, which is that if a sector or stock is going to have a bad period, but my analysis and my research throws it up before the market realizes it, then I go and sell off the stock from my portfolio. So the expertise works both ways in knowing when to buy and knowing when to sell. So that expertise, both in stocks and in sector selection, aids a mutual fund manager in delivering better performance. And the last line that's here, this better performance is defined in industry jargon as alpha. You know, this industry, just like many other industries, likes to use a lot of jargon. P ratio was one, alpha is another. So the alpha is nothing but the excess return. So let me explain alpha to you. So in the meantime, as I said, the volatility is what we are trying to counter through diversification. So how is this alpha defined for a mutual fund, right? So when we say better reward, right, the better, there is a risk and there is a reward. That's both are apparent on the slide in front of you. The better reward is when the market is rising, I am supposed to deliver a better, that is a gain in value greater than the market. So that is called positive alpha. So the market goes up 10%, my mutual fund goes up 12%, 12 minus 10, 2% is the alpha that I have delivered. And that is what is the intention of every mutual fund. And that is what the customers expect from mutual fund. That's one part of it. The second is to lower the risk, because there's alpha in that. What does it mean? Well, the markets are correcting, right? There's naturally a loss in value. Right? Sensex corrects, Nifty corrects, all other indices correct. So when it corrects, I can deliver alpha, right? The mutual fund by giving a lesser loss in value. So the market is down 10%. If I am down 8%, then 2%, 10 minus 8, 2 is the alpha I have delivered. So I wanted to clear this confusion that alpha doesn't always mean higher positive returns. Higher alpha means higher positive when it's so possible, that is the markets are rising, and lower negative when the markets are falling. It will be a dream world that is the markets are falling and I'm delivering positive, right? It does happen often. With the same thing, the opposite also happens. Your friends, market may be rising, but my fund may be falling. So clearly that alpha has to be earned and delivered. It's not just simply that I sit in a rising market and it comes to me. So that's an MF alpha. But friends, there is one more way that alpha is seen for mutual fund, right? The alpha, when I said market, in the previous slide, I just used a generic term called market. Now, what is market? A may say, Sensex, B may say Nifty, C may say Medicap Index. So each MF scheme, right? When I say MF here, I'm talking about MF scheme, has a benchmark chosen, which is defined when the fund is launched and is approved by the regulator, right? And this benchmark is what is chosen to represent the market for that mutual fund. So these benchmarks are fund specific, obviously, based on the suitability to the fund type. That is, for a large cap fund, you'll have a Sensex or a Nifty or a top 100. Mid cap, you'll have a BSE in mid cap or NSE mid cap. So each one has to choose an appropriate benchmark and communicate it at the time of fund launch, and it's always available. In fact, regulator has said that common people may not be so aware of the mid-cap index or the consumption index or a sectoral fund or whatever. So they have also stipulated that every mutual fund has to disclose the comparison with the Sensex or a Nifty, because that is what is commonly and easily available, understood. The channels, the newspapers all talk about it. So they have prescribed that when we disclose performance on a monthly basis, we should always give, in addition to the benchmark, a Sensex or a Nifty should also be given, right? So any MF, whether that's a conventional MF or this anti-MF that we are going to talk about, is expected to deliver the alpha with respect to the benchmark. So that's the second piece about the market, right? So one is that people will expect it to deliver better than Sensex or Nifty. Not always possible, because if you're operating in a totally different space, Sensex and Nifty are both large caps. If you're running a small cap fund, we give the information, but it's hard to expect a small cap mutual fund to beat the large cap index. But for whatever it is worth, the regulator has stipulated it and that is available to you to see. But the MF are expected to deliver the alpha with respect to the chosen benchmark. So that customers have to be aware of that. There's a third definition of alpha here. An MF alpha is also defined with respect to a peer set of mutual funds. Why? Because there are 44 odd AMCs in the country who are managing 400 plus equity schemes in the country. Right? Now, I choose a scheme. Now, as a person, yes, I do expect certain absolute returns because I have long-term goals. I do expect that your benchmark chosen, you will beat that. Right? But the third thing is, if my competitors are doing much, much better, then you will say, why should I be with your fund? Why not I go to a competitor's fund? So these peer sets are also fund category specific. So the large cap category, mid cap category, small cap. Now, luckily for us, there was a lot of confusion prior to April 2018. That's an important date for you to remember. It will come up later in the presentation. Before that, it was very amorphous. You know, a large cap fund could take some lot of mid caps, a mid cap could take a lot of large caps. So there was a lot of confusion and the names of funds were not helping. There were opportunities funds and names like that which don't clearly define. So SEBI came out and said, hey, these are the set of funds that I'm going to permit to the industry and I'm going to define what parameters you operate in. And so now for the last 2 years and a little bit, there is a clarity as to the categories on how we are to manage. The boundaries, the goalposts are fixed by the regulator. So that has got even more relevance today. So when does this alpha then is that can I do better than my peers? And when is it useful? It's mostly useful when you're making a new investment decision. Because at that time only you compare. Once you have made the decision, like comparing it and then saying, should I churn my portfolio? Should I redeem from this underperforming? Because who knows, the past underperformer be the future performer and the past performer be the future underperformer. So generally, it's not something that is done that once you've invested, you keep on looking, but no harm in looking at that in order to look at whether your choice was right or wrong. But mostly, this is the performance comparison as written in the slide here that advisors, distributors, and customers use when they are making an investment decision. Hence, any MF, whether it's conventional or anti, is also expected to deliver an alpha with respect to a predefined peer set. Okay, so that's the alpha. So like I said, goal-wise, both the conventional MF and an anti-MF is expected to deliver alpha as defined in the last few slides. So what's not different? What I just repeated, right, between is that both target alpha and have to deliver that. So now let's move to the crux of the conversation today, which is what is this anti? The anti comes from the path or the process adopted to deliver that alpha. Right? So, and don't think that path or process is one slide and then I'm done. The paths are multiple. It's like, you know, a river. All the rivers start from the Himalayas in India, but they go down, they distribute into tributaries and they reach the sea at different points, right? So like that, the processes, right, are multiple and there are a lot of choices ahead of fund manager. So what's different, right? We talked about in the mutual fund piece, right? I don't want to go back to the slide, but both the answers are here, right? They use expertise in sector and stock selection, which was the second line in that slide. So both of them use this expertise. But in the first line, when I said diversification, a conventional mutual fund uses diversification, but the anti-mutual fund uses concentration, the direct opposite. That's why the word anti-MF came about, because it takes a dramatically, directly opposite approach in terms of concentration, right? So what is this concentration in? First, it's a concentration in terms of sectors. So the conventional mutual fund generally diversifies across many sectors in order to stray to the risk minimization. Like I said, you can't predict which is going to go up, which is going to go down. So spread your risks. So you minimize the risk by diversifying across sectors. But an anti-mutual fund can choose to concentrate on a set of underlying themes. And how do you choose these themes? The in-house research team of the asset manager right? Gives the views on the prevalent economic drivers of GDP growth, and hence GDP growth leads to EPS growth, and hence future EPS growth expectations from different sectors can be very different in people's minds based on what your research view is. So that's where the expertise comes in, right? So concentration. What's this? Concentration in stocks. See, a conventional mutual fund, if you have invested in mutual funds, you will realize that they go anywhere between 40 to 100. Some have exceeded hundreds too. Our own Sundaram mutual funds, one of our funds years ago had 110 stocks. So conventional mutual fund is not limited. They can have, I've just written 40 to 100. Technically, it can go beyond 100. But the anti-mutual fund portfolio has a max limitation of 30 stocks, right? So that's the first thing, that concentration in stocks is limited to 30. Next, what's different again is the process of stock selection. See, generally, people, when you are either directly investing and you talk to your mutual fund through the web or through telephone, or you talk to your advisor or distributor, he tells you wait for 5 years. Mutual fund, you should always look at a 3 to 5 year minimum perspective, right? So, given the fact that that's the way the approach is, the conventional mutual fund generally have a 3 to 5 year approach on every stock, because they are expecting the general customer to be there for 3 to 5 years and to see that value delivered over that 3 to 5 years. The stocks are also chosen with that way in view, so the person who waits gets the full benefit. So, a lot of expertise, a lot of research goes into it, studying the company, the future growth, understanding their dynamics, their entry barriers in their industry, their many modes that they have which can prevent others from coming, any brand, any premium. So generally you try and study a stock and take a 3 to 5 year view and buy that stock, saying this stock can deliver in 2020 to 2025. But the anti-mutual fund has a dynamic approach to tenor of investment. It can buy stocks from a 3 months perspective too. It can buy stocks from a 5 year perspective too. That's the difference, right? So this process of stock selection is different. What else is different? The philosophy of portfolio churn. So a conventional mutual fund, CMF, generally has a buy and hold view. You buy the stock with a 3 to 5 year perspective and say, look, I have confidence in my research. And barring something very unusual happening, like the company gets sold or there's some corporate governance issue, something happens, you generally intend to buy and hold it. So the portfolio, the number of such buy and hold stocks you have, the churn of the portfolio will be less. So generally a conventional mutual fund has a relatively low portfolio churn. Churn meaning buying and selling stocks. But the anti-mutual fund has a dynamic approach to tenor. So naturally, if I buy with the 3 months, in 3 months from now, I'm going to change it, right? So you have a relatively higher portfolio churn. So that's one more difference between a conventional mutual fund and what we are calling an anti-mutual fund, right? So now, how this reflects itself is there another difference. So like you see, I am laying out peeling the onion layers. So this kind of a difference in the structuring the portfolio, what it leads to is you have the benchmark, like I said. So when you are taking these approaches, a conventional mutual fund, because his alpha is defined with respect to the benchmark, tries to keep a high overlap. That is, buy as many stocks which are in the benchmark, buy as much of the sectors that are in the benchmark as possible, because they want to minimize. That is, they are lowering the deviation from the benchmark sector and stock percentages. And it's not just about saying yes or no. It's about a percentage. Like the Nifty has, let's say, 25% of banking stocks, right? I could take 20% or I could take 30%. So the 20 is called underweight, 30 is called overweight. So that overlap, depending on each sector, how much I have relative to the weightage in the index, can make a difference. And so conventional mutual funds try to minimize the risk by lowering the deviation. But the anti-mutual fund has a dynamic approach even here. It says that I can deviate significantly if necessary. If based on my conviction that growth drivers of the economy are there, I can take a higher weightage of that. So I can maximize alpha based on my conviction, right? So deviation, and it's both ways, friends. It is a deviation upwards, which is overweight, or a deviation downwards, which is underweight, right? So this is another difference. So I have laid out a whole bunch of differences, right? So as a result of this differences, there's a final difference that I need to talk to you about. That is, the risk-reward dynamic is thus very, very different between a CMF and an AMF. because the CMF's approach is to minimize risk while attempting to protect the reward. The AMF's approach is to back the expertise of the in-house research team to take on risk where the prospect of higher reward beckons. Fundamentally different approach, and is where I called it anti-muse, because the antithesis of a thought process on risk and reward, right? And gets demonstrated how. See the beauty of how this actually works out in practice. Because if there's already a mutual fund, let's say I have 55 stocks in my mutual fund. My research team suddenly says that there's a new stock which has come up, there's an IPO, we have to buy it, it's an excellently priced opportunity, let's go take it. I can, in my normal conventional mutual funds, instead of the 55, add it as a 56 stock, because nobody on earth is coming and telling me limit it to any number. Of course, I will add it at a smaller bit because it's new, and gradually I can raise it. So that's it. But if the same idea comes to the research team backing the anti-mutual fund, I'm limited by my 30 stock portfolio. If I like the new idea, and my research team is egging me saying, so please, we need to buy it, I have no choice but to completely liquidate an existing stock holding to buy that new stock. Can you see? I have a choice to make. I can't say 30 becomes 31. So naturally, you're not only thinking of what you're buying, and when you're excited about what you're buying, you have to think about what you can get rid of. So that adds to the risk of the portfolio clearly. So that is what we are talking about. So now I have given you a primer on what are all the various things where an anti-mutual fund is actually the antithesis of a conventional mutual fund. So I've laid the background. I've given you the landscape in which this fund that I'm going to talk about. So now it's time to demonstrate these aspects of the fund in question. So I have to break your suspense now. So which is this fund from the Sundaram portfolio that I'm going to be speaking about for the rest of this evening? Hold on, that I tap the button. The fund's name is Sundaram Select Focus. Okay, the name gives it away partly. The word focus is there in the name. So one key dates in the fund's life. It's a very old fund. It's been there since July 2002. But there are some key dates in its life. In 2016, we appointed a new fund manager and we created a research deck, both based in Mumbai. As you know, Sundaram Mutual Fund is headquartered in Chennai. Our operations and generally the equity team and everybody, myself included, sit in Chennai, right? But for the first time in 2016, we decided that I will come to that in the next slide on why we decided, but we decided that we will take on a new fund manager to manage this fund, and to support him, we will create a research deck also. It's not that that's the only research desk supporting him. He's free to tap into the research desk, which is based in Chennai, where we have 10x the number of analysts that are in Bombay. So we have a 20-strong fund manager come analyst team in the company, which is all available to the fund manager, but we created this dedicated team in Bombay. So that's a key date to remember. September 2016 is when the fund manager, who is the present fund manager, started managing the fund. Because clearly that fund manager, with the new thought process of the AMC in terms of basing in Mumbai, started a new lease of life for the fund from then. And then another important date came in. Almost a year and a half after he took over, and he was managing it in a particular style and a methodology, SEBI came out with the recategorization of schemes. Now, like I said, we felt this was a large-scale fund on our side, and what we chose to put it into the focused fund category. A, because the name was there for a long time, and two, because we wanted to manage it in the AMF way, which is what? The anti-mutual fund way, which is brilliantly supported by the focused fund category. So we recategorized. In the recategorization, we chose to put Sundaram Select Focus in the focused fund category. So from April 2008, it had to follow what the focused rules of SEBI stated. Right? I'll come to that in a bit. But these dates also carry significance for us from another perspective. So the relevance of these dates in the fund's life. So 2002 to 2007, this fund was a star performer. It won the best performing large cap fund award 2 years in a row, right? Brilliantly managed at that time. Then in 2007, the global financial crisis came and hit the world. This fund had certain portfolios which did not suit the new environment, but could not get. So it went through almost 9 years of severe underperformance, with respect to benchmark as well as peers. It had 3 to 4 fund managers managing it, one after another, one after another. It was just not improving. So I know there are a lot of investors, I don't know how many of them are in this webinar, but who had invested, seen the good times and then experienced the bad times. And so this fund was obviously hurting us big time, because having been the best and then almost close to the worst, it was hurting us. But we felt that this was an important fund for our life, because it was one of those funds, along with Sundaram Select Midcap, which was the Punarjanam of our mutual fund AMC itself, because these two were launched on the same date in 2002, when our partner then, Newton Asset Management, left and we became Sundaram Mutual Fund. So sentimentally, this is a very important date, because that launched us into the equity space in a big way. So this underperformance was hurting. We wanted to do something to improve the situation and do that. So what did we do? We went and hired the new fund manager, created the research desk based in Mumbai, and handed over this fund to that fund manager to manage with a mandate. Right? So he is the present fund manager from 2016 September. He's now managing it, and the mandate to him and his thought process. And he came from a space which understands large cap, which is the insurance industry. Right? So that's one of the reasons we looked at it from that perspective, and he started putting in place a clear strategy to deliver outperformance. And then the April 2018 date happened when we recategorized it. So then what we had to do, we had to restrict the portfolio to 30 stocks, which is the rule on focus category. And this strategy, which I've been referring to as the anti-MF strategy, it's not referred that way internally, my dear friends. It's just I've chosen that only to make this presentation. Internally, we don't call it an anti-MF strategy or anything. It is just something that I thought is a good way to speak about the fund. Okay, that's it. But that strategy he started fully implementing from April 2018. So when we then go through the fund, obviously we will look at some aspects from 2016, but some aspects we'll look at it from 2018, because that's when we have a clear mandate for the fund and a clear comparison that we can do with a level playing field which SEBI created from that onwards. Right? So that's the relevance of these dates for your information. And this is the fund fact. So what is it? Like I said, the first 9 there, allotment date was July 2002, started 30 stocks and a focus on large cap. Right? So it's not only just a focus fund, it's a large cap focused fund. Now SEBI's rule says minimum 65% should be in large cap. That's what in the middle of that you can see. The rest of these things are not very critical. They are there. If any question answers come about the fund or the load structure, we can always come back to this slide. Going forward, what are the characteristics of this fund? So first things first, I mentioned that it was star performer, then underperformance, then again it is now with the new fund manager and started delivering performance. Despite all that checkered history, it has still delivered 17% compounded annual growth since inception. So that's one thing, that's why I've highlighted it in blue. The second part, 30 stocks, we already spoken. The third, we chose that while SEBI says 65% large caps, as you may see in the middle of this slide, we chose to say that we want to make it truly large cap, and we will have 80% of the corpus in large caps. So please note this important point, that way beyond what SEBI said for a large cap focus, we have chosen an internal parameter that we will try to keep it at 80% at all times. That's one important note. Second is the next point which I've highlighted, is that we would follow an approach of 3 to 4 high conviction themes. So that's the second aspect of the anti-mutual fund thing. Like I said, diversity versus concentration. So the first concentration comes on the stock piece, second concentration comes on the focus on 3 to 4. The next one is obviously, like MAMF, I have to deliver alpha. So when I buy a stock, obviously I want to buy it cheap so that I can sell it costly. So buy low, sell high has been the mantra of the stock market for donkey's years, right? And so that's what the principle called GARP is, growth at a reasonable price, is the underlying philosophy of all of funds and even this this fund. The benchmark of the fund has been chosen to be the Nifty. This is a 100% large cap index, right? The Nifty. The TRI refers to the fact that dividends are netted off, so you get a true and fair share of comparison. Just a summary, right? I'll leave it on here. I will not talk about it, but because just that the definition of large caps also SEBI has stipulated that the top 100 companies in the stock market, when you sort them in descending order of market cap, is what would be the large cap space as defined by SEBI. So just for information. And now we come into the fund itself. So what's happening here? As you see, he was managing it in a relatively concentrated style ever since he took over. So clearly his thought process was already there that I would like to do this, and the fund house also had always had, but it had gone to 40 plus stocks because it was nowhere specified. So it was called focus fund, and there was no specification either by SEBI or by anybody else, and he had taken liberty there. When he came over, straight away he started to 33, and when then in second quarter 2018, when SEBI's rule came, since then he is at 30. So the concentration of the portfolio in terms of the stocks is clearly readily apparent here. The next is that large caps that I mentioned, right? Now, if you see here, April 2018, it had 80.9% large caps, and in May 2015, it has 82.7. So these are 2 points in time, and the Nifty as a benchmark is 100% large cap. But let me show you this quarter upon quarter. Can you see there? Large caps have been consistently over the last 4 years, right? From September, then almost 4 years has been maintained. But I'm showing you here from the time of the SEBI recategorization and this becoming a focused category fund, it is at 80% plus. So can you see there? Every quarter, it's at 80%. What varies is the amount of cash and the amount of mid caps. The difference between 100 and 80 is shown for you. We will discuss some of these aspects in a little bit more detail later, right? So that's the second thing I wanted to reinforce about what the fund's position is. The third is that this market cap of the fund, right? If you look at it compared to the benchmark of the Nifty, the anti-mutual fund characteristics, which I want to point out here, is how it is dynamically managing the market cap. So bear with me for a minute while I explain this to you, right? It has 80% large caps, Nifty has 100% large caps, correct? So clearly that if I'm maintaining at 81, 82, 83, 84, whatever, I'm not at 100. So clearly my market cap is going to be lesser than Nifty, but the amount that it is lesser is in my control. By the one, if I take some amount of mid caps, automatically is going to be lesser. But within large caps itself, I can buy the bigger large caps or the smaller large caps. So that dynamic management is one of the features of anti-mutual fund management here. Because if you see here in the last column, the ratio to Nifty market cap, it varies. And in the small table at the right, you can see that if the lowest has been 70%, the maximum is 87. So it has taken us 17% delta in terms of choice of market cap. On average, it's maintained 80. So file this away that the fund is very dynamically managed on one aspect. Now, let's understand and evaluate this focus. Since its rebirth as an anti-mutual fund in the focus of focus fund in April 2019. Right? So what are we going to understand and evaluate? You remember I took you through a primer on what we perceive as the anti-mutual fund characteristics. So we will use the same parameters to demonstrate how this fund is doing that. Right? So first, like I'm just repeating those slides so that you can freshly remember. I'll just show it to you and then I'll move to our fund. Right? Concentration versus diversification. So why do we believe in concentration? It's because we believe that a manageable number of stocks develop conviction and therefore good size. Is if you have a good feel about a particular stock based on our research, you can take it in a decent size, whereas diversification when you take small bits. So it can enhance the reward potential. And simply buying more number of stocks for the sake of diversification itself can add to risk because you're adding a lot more unknowns because you may not be studying 100 stocks as well as you can study 30. So simply buying more number of stocks doesn't necessarily contribute, it can actually add to the risk. So that's the philosophy behind concentration from a Sundaram perspective. So now look at the high conviction and the super concentration of this fund. What have I shown you here? I'm showing you the ratio of the top 10 stocks. Now 30 stocks account for 100%. If I give equal weightage, I will get 3.3%, right? 100 divided by 30. If I take that into 10, then 33% should be top 10. I am at double that. So just 10 stocks are 60% of my portfolio. So this fund is a high conviction fund. So that's a message that an anti-mutual fund has to have high conviction. There's no other way out of it, right? That's one. Second, if you see the change, the QOQ word will keep coming through the presentation. Let me explain. It's called quarter on quarter. So I'm showing you the data quarter, because showing monthly data will be in a whole mass and you won't be able to make sense. So I've chosen quarter as a reasonable period of time to demonstrate the flow of this fund. So if you see there, the green in the change quarter on quarter, the green means they hyped it, the top 10 in that quarter. The red means they dropped it. So can you see even this top 10? In some quarters, he takes it up by 3%. Some quarters, he's taken it up by 10%. Some quarters, he's dropped it. So conviction is not just blindly that I'll keep top 10 at 60%. No, there is thought process, there's research, everything going into that to manage this. But by and large, we are trying to keep it at a 60% level, as you can see. The last 2 quarters, I will come to later. There's a specific reason for that. And we'll end of the presentation, I'll cover the thought process. Now we talked about top 10. Forget top 10. Look at just top 3 stocks. So I'm going to demonstrate to you that this is a high conviction fund, means it's a confidence fund. It means that our research, we back our research and the thought processes to really put our money where our mouth is, where we talk. When I say conviction, see, my 3 stocks are accounting for anywhere between 22 to 26% of the portfolio. So am I getting across that anti-thought processes versus a normal conventional mutual fund? It's there for you. So high conviction on stocks. Next, we talked about this aspect, 3 to 5 year view and AMF as a dynamic approach to tenor, right? So which leads to the philosophy of portfolio churn, right? That same buy and hold versus higher churn. So look at the portfolio churn. Now 30 stocks is what is allowed for this fund. We have had 9 quarters, right? So 30 into 9, 270 should be the stocks. So I've given that total. But in this period, since April to now, 2000, that is the 9 quarters that we are talking about, 30 stocks is also allowed, but we have tried out 52 stocks. So can you understand that? That means what? I am putting in a lot of churn. I'm willing to try out a new idea and hold it for some time. The second thing is, though I tried out 52 stocks, 25% are long term. So let me take you to the table to explain this. So the first is portfolio churn holding period. The next row tells you there are max possible 9 quarters. The next column tells you at least for 8 quarters, which stock have I held? Right? So what does that tell you? 13 stocks. Out of the total 52 I've tried, 13 stocks I actually have held for at least 8 quarters, which means 25%, right? 13 divided by 25% of the stocks I have a conviction to hold. So when I say churn, just for the sake of churn, it's not that I'm just going and putting a stock, taking it off. No. It's not for the fun and games. When there is a conviction behind a stock, I'm willing to hold it. So quarter of the portfolio has been held for 8 to 9 quarters. At the other end, look at it, less than 2 quarters. That is 6 months time, right? 19%, that is 10 stocks of my portfolio. I tried it out, but the thought process that I had did not turn out right. I gave it 2 quarters and then found that it's not going. Either the company did not deliver as expected or the market situation changed for the company and so the sentiment was not favorable. I did not hesitate. I just got out. Take stocks for 3 to 4 quarters. Holding for a year means I gave it a long rope. Another 20%. So there are 20% of 1 year holding, 20% of 6 months max holding. That means 40% of my portfolio, I have realized that the promise that they had for some reason has not delivered, and instead of sticking on that stock and buy and hold, no, my conviction, my research is right, ultimately 3 to 5 is delivered. No, I ruthlessly cut it from my portfolio and switched for other stock. So I hope this slide has made that thought process very clear, that the portfolio churn is high, but it's not high just for the sake of being high, that where we have conviction and that is being demonstrated by that company's performance and the market's outlook, we do hold. So 25% of portfolio we do hold. But where there is a disappointment in terms of the performance of the company or in terms of this, I'm ruthless in terms of cutting. So this demonstrates the anti-mutual fund character in one more reinforced strong way on terms of the fact that I am comfortable with churn as long as, that is why I said, a bad stock, when you saw the EPS growth, if I see an EPS growth decline in that stock, then I have to sell, right? So I can't just avoid a churn because the market is dynamic and I have to be dynamic. So that's the thought process which we are implementing and demonstrating to you in facts and figures. Now, next we come to the sectors, right? Concentration of sectors we spoke about. And in that, if you notice, an AMF can choose to concentrate on a set of underlying themes. And as you saw in the fund facts, we said we have chosen 3 to 4 themes. So here's another demonstration of our high conviction, the super concentration in terms of 3 to 4 themes. So you see here, this table tells you the right extreme, top 4 themes account for anywhere 70-75% of the portfolio of most quarters, except the last 2. Like I said, last 2 quarters, I will explain to you at the end of the presentation today, right? It's because of the COVID crisis, right? So I'll come to that at the end. But otherwise, it's been the 4 themes taken, but take it, one theme, top theme, is taken almost 35 to 40%. So that's what I said, right? Backing the research and the conviction with the numbers, right sizing the portfolio. I don't get scared of taking a concentration in a sector or a theme which I believe has strong legs to deliver alpha. So that confidence of that fund management team and the research team comes through very strongly. I know I have piqued your curiosity. You'll be wanting to know, hey, what is this one theme that you have kept 35-40% and what are these 4? I don't intend to hide it. I intend to reveal it. So these are the 4 themes. The top theme is BFSI, banking and financial services. It includes banks, it includes NBFCs, it includes insurance companies, it includes asset management companies, it includes wealth managers. The entire BFSI space is something as a fund house, the research team has backed it, and this fund has actually maintained that as the top weight right through 9 quarters. But when you come to the second, can you see the difference? In the first 4 quarters, it had IT. Then it briefly went to FMCG. Then 1 quarter later, it realized that this was not working in that strongly. And so we brought in industrials. So it doesn't mean that we felt it was bad. FMCG moved to the 3rd spot. That's it. But the relative concentration of industrials at that point of time, we felt was good, the fund manager and the research team. And next was petroleum. So in this petroleum, I've deliberately left it at white color because between you and me, petroleum is nothing but Reliance Industries. But we know that Reliance Industries actually telecom is the reason valuation. So it's technically that sector being named as petroleum is not technically correct, but that's okay. But that's where the industry classifies it, and so we should be there. Now, 3rd, you see. So if you see 2nd, 3rd, and 4th, there's a lot of musical chairs going around. That is, so this conviction and concentration. So where we have conviction strong, we keep it as top. But in the 2nd, 3rd, and 4th, though this part of this theme is there, the relative weightages, we are flexible about giving one a little more than another. So the dynamism and the conviction both come through in terms of this thought process, right? So once again, the anti-mutual fund thought process clearly demonstrating itself. 3rd, cash. When in doubt, people go to cash. Oh, I don't know, market is going to go up or down, let me keep it. Or I feel market is going to go down, I'll keep cash, I'll buy when the nothing. That's not. When you have conviction behind something, then you can't be going to cash because cash is not a return generator. Cash is a protector of downsides, right? So we do use cash. So this fund does use cash. So if you see every quarter, so there are 2 points I want to make. That the fund always keeps some amount in cash to be able to buy, right? Because buying and selling can take place. But that morning 10 o'clock I want to buy, evening 4 o'clock only able to sell, because by the end of the day I have to be in my portfolio at 30 stocks. As you saw, every quarter it has been 30. I'm not maintaining 28 stocks so that I can see a new idea and buy 2 more. No. I have fully invested in 30. So if I have to buy something, I have to sell something. So the reason for cash is, one is I want to buy so that then later during the day I can sell off one more stock, or I may want to top up my existing stock. Already have 8% or 6% of a particular stock, I can go, we'd have a self-limitation of 10%, SEBI also says the same. I can buy with the cash, I can top it up. So without needing to add an extra stock, I can top up my holding with cash. Third point in cash obviously comes with, if a short term, I feel that the market is in a situation, it's a bearish tendency, is likely to be correction, you can take a little more. But there again, if you see the last 2 quarters, one of the reasons I'll come back to later is 7%, which given our average about 3 to 4 is almost double. But that's because of the COVID crisis. Like I said, I'll bring this point up later. But so you can see here that the high conviction means that our cash levels have been at single digit levels, but it's never been zero is also a point to know. So the fund manager, in order to right size the portfolio, feels that if he bought something at 5% and wants to increase quickly to 8% because his initial thought process of that stock is really turning out well, and so he would like to cash in on the opportunity, he keeps some cash at all points. So both in terms of not zero cash, at the same time not double-digit cash, the fund clearly, and you can see it's a dynamic feature. So the red on the change column, you can see the red tells you when he got the cash down quarter on quarter, and the green tells you when he hiked the cash quarter on quarter. So that tells you that it's not just consistently staying at one cash level, that is also a dynamic play, right? That's another part of the conviction piece. Next, we talked about what? We talked about the overlap with the benchmarks, correct? Same slide, I've put it back on, that a conventional mutual fund generally has a higher overlap, whereas the anti-mutual fund has a dynamic approach to overlap. So what do I mean by that? So this is the stock and the sector overlaps of this fund with the Nifty. So if you see in the stock overlap, what can you see there? The stock overlap is anywhere around 60-60%. So down below, if you see, the average stock overlap is 59.4. So 60. This is on an average, 40% of the stock weight is outside of the index. Why is it so high? Because the fund manager's conviction. Second reason it's high, the Nifty has 50 stocks, 100% large cap, but the fund manager can buy the top 100 as per the SEBI definition of large caps and as the market also allows. So the buying the stocks outside of the benchmark, right? And I told you also that he maintains 80% large cap, right? So the fund has a 60% correlation with the Nifty, but a 40% he is taking bets outside the Nifty. So the confidence factor of their dynamic approach seen in the stock approach. Whereas when you come to sectors, I know we identified themes, and then when you go to the sectors, he has to keep an eye because the alpha has to be generated with the benchmark. So if you see, the sector overlaps are significantly higher than the stock overlaps, right? While they are significantly higher, the range is also almost 20%. So he's gone as low as 65, but as high as 86. Right? And there's an 88 there. The reason I'm not taken is that's March, that's pre-SEBI circular. I've given that line only to calculate the change quarter on quarter for the first quarter in June. So that's the only reason there. So in this period, he's had a 20% variation, so indicates the dynamism, but it's higher than the stock overlap. Why? Because he feels that the sector is in the Nifty. So if the Nifty is going to do well, the good sectors in the Nifty are going to do well. So he has to buy the sector, but what is he doing? He's buying a stock in that sector, which is not in the Nifty, but it's in that sector. That's what it apparently tells you. The reason the sector overlap is higher is trying to stay within the sectoral things of the Nifty, but he is exercising his flexibility and dynamism in choosing stocks, which are not necessarily 40% by market cap weight is outside of the Nifty. So again, the anti-mutual fund characteristics comes through very clearly in terms of stock and sector overlaps. Yes. So I'm done with telling you how the process or the path of Anti-MIOs are different from conventional mutual funds. How Sundaram Select Focus has implemented that in full style, that it's taken a difference. But all of this is of no value if the alpha is not. So that's the crux of the matter. Has this fund, doing all this dynamism and anti-MF thing, been able to deliver this alpha? Right? So first of all, where do we compare this alpha? Obviously with the benchmark, that's number one, I told you. Second is with a peer set. So I must give you a word. Now, it's a focused fund, but we don't see this fund as being compared with other focused funds, because in focused funds, SEBI allows focused to be focused large cap, focused mid cap, focused small cap, focused multi cap. You can choose. So in about 20 focus funds, there are some like this, some like this. There are only 2 or 3 large cap focus funds in there. So just comparing with those 2 or 3 large cap focus funds alone is not, because we see this fund as a large cap fund, but just that the style is being followed is of the AMF style as a river, which is different. So we are going to compare this with the large cap peer set, because that's where we are 80% large cap, which is what all large cap funds are mandated to maintain. So we are entitled and right to compare it there. And we also want you to look at this fund as a large cap fund with a difference, right? So to that extent, let us now come to the performance. So first I want to take you through how the large cap category has done. So I leave this slide on for a minute for you to look at it. Because red means underperformance versus the Nifty, green means outperformance versus the Nifty. We have taken the data from the date of the SEBI regulation, so from the quarter ended 29 June. What are you seeing? This is the average of all the large cap funds in the market. How many there are? I will show you in a couple of slides, about 27, 28, 29, depending on which year you're talking about. So this is the average return of the conventional large cap mutual funds in the large cap space. They have struggled to beat the Nifty. As you can see, in most of the time you are seeing a red. And when you are seeing a green, it is a marginal green, 0.3, 0.9, 1.1. So large cap funds have struggled. So before I move on to the next slide, I must tell you that for mutual funds, whole reason the ETHRA, as they say, is to deliver the alpha with the benchmark. They have obviously miserably failed in the large cap space. What's the reason for that? I think we should take for a minute and understand this before we move forward. Because I'm sure that if you look at the market, the large caps are the largest category of the market in the mutual fund space. And a lot of you must have invested in large caps and would have been disappointed with this performance. A lot of you would have been advised to large caps saying these are safer sectors than the high risk mid cap and the high risk small cap. And you will say, but I'm not able to beat the Nifty here. What is the reason that's happened now is because these are all point-to-point returns. And today, because the market is down, all the back returns are also painted badly, number one. But more importantly, I would say is that in the large cap space, in the Nifty, what has happened is that large institutional players come through what is called as the Nifty ETF, exchange traded fund. Now, or through an index fund. Both the exchange traded funds and index funds have to buy every stock in the Nifty. They have to copy the portfolio. So they are not allowed a tracking error. You have to keep it very close to the Nifty by the stock. So the outlook, there is no somebody saying that this will do better, that will do. No, they have to blindly bet. But a fund manager is sitting and saying, hey, this sector is not going to do well, hence this stock will not do well, so I will take less of it. You saw the stock and sector overlaps, right? So they are taking those calls. Now what happens is that in a time when the market is just buying everything, certain stocks just go up. So because of that, the fund managers get into that kind of a thing. That is one thing. The second reason this happens is that by SEBI mandate and by internal rules of IFMCs, the limit of what is the percentage of a stock I can own is limited. But in Nifty has no such limitation, because if a stock price goes up, its share of the index goes up. But I have to cut my portfolio if it crosses my threshold. So generally the threshold, let's say, is 10%. So if a stock goes to 14%, as happened to a recent stock, all of you are aware, I can't buy 14%. So to the extent that stock, when it went to 11 itself, I can't buy anymore. From 11 to 14, it has gone because the share price has appreciated. So naturally, I have lost out because that which was appreciating in the Nifty, I don't hold to adequate levels. So these are the kind of things why this happens. Generally speaking, over a longer term, when you look at the rolling return analysis, I'll try and demonstrate that to you a few slides later. Funds would be able to deliver alpha, but in the large cap space, because of the presence of these players like provident funds, ETFs, which have large monies coming and going, whereas in the mid caps and small caps, we don't have those kind of things, and so there you find that there is a lot of alpha, but alpha is both ways, right? Positive alpha and negative alpha. But I just thought a brief diversion to explain why the whole large cap category average as of today, as you look at it from today, point to point, 1 year, 3 year, 5 years, they are not able to beat the Nifty. Correct? So that's the state of play in which my anti-MF is coming to play. So how has my anti-MF done versus the Nifty? So what can you see? Yes, it has also not outperformed the Nifty at all times. But you not see a lot more greens than here? Right? This is mostly red, but you can see this is roughly equal in terms of red and green. So clearly, you can straight away see from right that our anti-mutual fund Sundaram Select Focus has done better than the category average. That's intuitively jumping at you from the screen. So I'll not leave you in suspense, and I will take you to the anti-mutual funds performance versus the large cap conventional mutual fund category average. Hold on to your seats. You can see how that outperformance versus your conventional, how the anti-factor is coming to the fore over a period of 9 quarters, not 1, 2 years, and over a period of 1 year return, 2 year return, 3 year return. When he started off, it was on the back foot on a 5 year because the historic, as I told you, the fund had been a very bad fund in the prior years, and so it took time for the fund manager to get the 5 year return also up to speed. But since the last 1 year, last 4 quarters, even on the 5 year basis, he has consistently beaten the large cap CMF average. I can stop this question right now and say, here you have it, but I'm not going to do that. Why? Right? You have to also look at it from other aspects, right? Like the risk and everything else. So let me take you through how this fund is being delivered this kind of a superior performance. So it has been able to deliver peer category alpha. It has not delivered the benchmark alpha consistently, but in a situation where the whole market has not delivered, I think that's a clear good performance, and this demonstrates to you the alpha that this anti-mutual fund has been delivering. And we saw the numbers in percentage terms, but you know the industry has a practice. A lot of advisors who are on this call will know what I'm talking about. We call it as Q1, Q2, Q3, Q4. Q is nothing but quartile. Quartile is nothing but every 25% block. So 100% is divided into 4 quartiles. So you have the top 25 called Q1, next 25 called Q2, next 25 called Q3, next 25 called Q4. So can you see here, the fund has never been in Q4, never been a bottom. Those 5 years, I told you first when it took time to go by, it was in Q3, but otherwise it has consistently been in Q1 or Q2, which means you can say safely that most of the time it has been in the top half of all large cap funds, and many times it has been in the top quarter. Now, this is the way the market treats it because it's easy to compile, like I said, Q1, Q2. So people like to put in Q1, Q2 funds and everything. So that case is made. But I want to refine this more because Q1, and how many funds did I say? I didn't tell you. So now I'm going to tell you. There are 28, 29, 27 funds here. So look at this fund in terms of its ranking. So like I said, in 1 year, there are 28 funds because the NFO got launched last year. 2 years there are 27, 5 years there are 27. So out of the 27 funds, this fund has been ranked in the top 10, except for the 5 year period, consistently, and the number of periods where it has been ranked 3, 4, 5, 1, 2. So I don't think I need to reinforce the superior and the super performance of this fund despite adopting a non-conventional approach. This is what I'm calling as an anti-mutual fund approach to management. I've shown you how it's very different. Repeatedly, I have demonstrated that through various slides. And the net result is that in that kind of a dynamic, flexible, high conviction, confident, backing the research basis has delivered value and alpha in terms of the peer set, and it's been among the top performing large cap funds in the country, as you can very well see, right? So Sundaram Select Focus has delivered better on the alpha aspect compared to the peer set of large caps. But I just don't want to leave you with saying, oh, look at the returns. Risk and reward go hand in hand. This fund has been taking higher risk, which is the ethos of anti-mutual fund. So how has it managed the risk-reward equation? You should be aware. So there are two ways of looking at risk and reward. So I will demonstrate that. So there's a technique called rolling returns analysis. So let me explain that to you without this slide. So then your slide makes sense. So today when I showed you the returns there, they are point-to-point returns. So let me take you to the category average returns. That's where we showed absolute returns, right? Or this. So when you are saying this, it's from today, 1 year back, today, 2 years back, today, 3 years back. But that same situation could be different 3 months before, 3 months after. So you don't know, you can't say that, oh, I delivered 5 years this return, so next 5 years it delivered that, right? So how do you come up with a basis to look at it saying, and now it's looking good, but was it looking good yesterday? Was it looking good 1 year ago, 2 years ago? So now it's very hard to do that with the peer set because all 29 funds, I can't be sitting and doing everything. So naturally, you have to restrict yourself to the benchmark. So now what do you see? In order to take away the timing aspects of the fund, in order to take away the timing, that I'm investing in a bad time or a good time, the rolling returns analysis is a system by which you evaluate a fund's performance by saying that, what if I invested today, tomorrow, the day after, the day after, the day after, starting from the day the fund was launched. Correct? Why do we do that? Then you know that I may start today, I may do a 1 year outlook. In that 1 year, market could have collapsed, market could have boomed. So you get both scenarios. So if I do it for every day, I'm going to be over a period of time, have a large number of data points where I've looked at 1 year returns. In those periods, I could have sometimes invested in a very bad phase and exited in a good phase, super returns. Or if I've invested in a super good phase and exited in a bad phase, very bad return. So you get that. So if you do such a rolling return analysis for a fund, you get a clear picture that putting money in that fund versus putting it to the benchmark, right? And as you saw, it's a checkered history with the benchmark for the large cap category and for our fund. You will know how many times it has done better. Today is the situation I already showed you. So that's where the rolling returns analysis, which we have done, this rolling return analysis, I've done it from the date the fund manager took over, which is October 2016. Because he's been managing from then. So to be fair, I can't burden it with saying the previous. And the strategy was, he was already taking 33, 34 stocks, and it went to 30 in April 2018. So I have said that this is this fund manager's performance. So if you see here, it says, what does it say? I'll take you through this table for a little bit for you to understand it clearly. So the first line in the table, the yellow part, it says risk reward analysis of select focus versus the Nifty. The next, it tells you the rolling return method. Then it tells you the 1 year rolling returns, 2 year rolling returns, 3 years, because that's the max, right? These only come from 2016. Then it tells you the number of periods we have. So I have 900, we have fund Nifty, difference fund Nifty, difference fund Nifty, difference. The next row tells you that I have 975 1 year periods, 609 2 year periods, and 244 3 year periods where I could have invested in this fund since October 2000. So you have a significant number of data points to evaluate. And like I told you, this gives you the return of, I might come enter in a bull, exit in a bear, enter in a bear, exit in a bull, vice versa. So what the average return the fund delivered and what the average return the Nifty has delivered for the same time period, like to like, comparing apples with apples. This fund delivered an average return of 10.3, Nifty 9.6. So the difference in green tells you that it's delivered 70 basis points or 0.7% better on a 1 year. On a 2 year, it is flat, just 0.1% lower. On a 3 year, it is 1.2% better. So clearly, on an average return perspective, the fund has by and large beaten the Nifty, and even it has not beaten also, it's just marginal. So good performance from that perspective, from a risk reward return perspective. Let's look at the reward of it, which is a max return. That is Chandi Lagai. You invested in this fund at an excellent bear market. Everybody was very negative, and then you exited in 1 year in a good market. You made 40% return, the maximum return. But a similar situation for the Nifty. That is, you entered at the worst time of the Nifty and entered at the best time in 1 year's time. You only made 9% return. So if your timing turns out right, the reward, this fund has given you 30% excess returns on 1 year. The Nifty, in 2 years, it has given 10% excess maximum return. That is, when your timing was great, and in 3 years, it has given 8%. So clearly, when the going is good, the fund has been able to easily beat the Nifty because of the conviction behind teams, behind stocks, and behind the research and the expertise that it has got. Right? Clearly demonstrated. Now let's look at the risk part of it, which is the maximum loss, which is I entered in a very high market and exited in a very bad market. That may happen in 1 year, 2 years, or 3 years. So clearly we are looking at a loss scenario, right? When you enter at a high and exit at a low, it's like buy high, sell low. So this fund had a worst 1 year return of 28%, but the Nifty had a worst 1 year return of 32%. So it has done a better job than the Nifty in managing downside risk on a 1 year basis. On a 2 year basis, yes, still done better, but I will not say 0.5% is marginal. So let's say equally to the. But on a 3 year basis, again, 1.3%, that is 130 basis points, better downside protection than the Nifty. So what I want to tell you is, despite its anti-mutual fund, dynamic and backing the conviction and the confidence kind of an approach, this fund has managed what? Average returns, maximizing your good times and minimizing the loss in the bad times better than the passive benchmark. So I think that on a risk return metrics, you have to say that the anti-mutual fund philosophy has paid off. Now, this is one way of looking at the best and the worst. There's another way of looking. There are 975 periods, 600 periods, 241 periods. What is the probability, right? All these 975 entered, I don't have any idea of timing. I don't know. People are saying now is a good time. Somebody is saying this is a bad time. On an average, on a probability basis, if I just blindly put the money, what is the likelihood that I will get back my capital? Because I want to avoid a loss. Primarily, we all want capital to be protected at least. Third is, why do I invest in equity? I want to beat inflation. Now, what rate of inflation? Today we are at 2-3% of inflation. Okay, but it's not fair to take 2-3% and give a nice comparison. So I have taken 7% as the return that you at least expect, because over the long term, 7% is an inflation rate. So if you deliver 7% plus, you can be reasonably confident that you have created additional wealth. The purpose of investment is what? You are postponing today's consumption to tomorrow. So if I can buy one car with my money today, 10 years from now, I should be able to buy 2 cars. That's wealth creation, right? So unless the car price is going to go up with inflation, no. So unless I grow my money faster than inflation, I'm like, I can't buy the second car also with my, say, and I'm giving up the opportunity of buying a car today for that, right? Because I'm putting my money into the market. So I've chosen 7%. In the next slide, I'm just giving you the preamble to the slide so that I can quickly go and tell you in the same set. The probability of loss or gain was a Nifty. The probability of positive returns, which is protecting your capital, is 83% for this fund on a 1 year basis, 85%. So it's slightly less in terms of the riskiness, that positive. There is a 1.5% chance. How much is that? That means what? For this fund, 100 minus 83, 17% of the time, I risk that I will not get my 10 rupees back as 10. It could be 8, 9, 5. How much can it be? The worst is that minus 28% return, which is 10 rupees becomes 7 rupees 20 paisa. Right? Just to give you. So the probability of that is 17%. So 1 in 6 is 17% is 1 in 6 times, which is Nifty 83, 85. We are at 83. Okay, that's take it to 2 years. We do slightly better than the Nifty. Take it to 3 years, we do 7% of times better than the Nifty. In fact, if you waited 3 years with this fund, there's only a 4% chance that you would have not got your 10 rupees back as 10 rupees. Right? And how much is the worst return? Minus 3.2% per annum. So for 3 years, 3.2 plus 3.2 was about 10%. So there are 4% of the time when you could have lost money all the way up to your 10, dropping as low as 9-ish, roughly. The compounding effect will take it. So the fund over the 3-year period clearly has done a better job than the Nifty's passive investment of giving you a higher probability of getting your capital back, or to put it the other way, a lower probability of getting a loss of your capital. Clearly, the fund has done a good job in terms of that risk. Now let's look at the reward. Reward is what? Hey, I put my money in. Have I beaten inflation? Now, I'm not comparing each year's inflation with each year's. I've just taken a flat 7%. I say that if the fund delivered 7% or the Nifty delivered 7%, you have got definitely better than inflation. I know there are times when inflation was 8, 9, 10, but we have to take an average and go forward, right? So I've chosen 7, which I think we can't quibble, given today's inflation rate is really double of the inflation rate today. Now, in 1 year's time, what happened? This fund delivered 7% plus return 64% of the time, whereas the Nifty delivered 67%. So there's a 2.5% less. Right? In 2 years also, it is 3.5% less. So clearly, the fund at all points of time has not been able to deliver that big alpha over 7%, right? As much as the Nifty, but I wouldn't say those numbers are very far away, but let's admit it, there is not. But when you come to 3 years, the tables are turned, and this fund has got a 2% better chance, probability is chance, right, of giving you a 7% plus, and that number is 68%, which means 2/3 of the time, the past history tells you that the probability of your getting an inflation beating return is 2/3, right? So when you say that I invest 10 times the market, 7 times out of the times I am going to get a. So this is a property, and this rolling returns analysis, this utility comes because the base you're using is large over a long period of time. This is 3 years, but you know, if we can do it over 10 years, 15 years, 20 years also, if the fund is in existence for that long. I'll show you that for this fund in this history also in a later slide. But the key is this is a very good predictive tool also, because by and large, a longer term study of the history tells you a reasonable confidence to be able to guess the future. Nobody has a 100% astrological way of saying this will happen, man. But this rolling returns analysis, in fact, I will probably do a detailed session on rolling returns as part of a deep dive series of webinars that Sundaram is planning to do. Make sure that we'll keep you all posted. So that's a good way that you could yourself try and do it. It needs Excel skills to some extent, which I think most of us have. Second is there are advisors who can help you with doing that. So that's just a brief glimpse into a rolling returns methodology. I'll try and do a detailed session for you in the weeks to come. So this was risk return metrics in this particular way. There's another risk reward ratio on a comparable basis. What is that? Sorry. This is just a summary of what I said, right? So now, I want to take you to a slightly different thing, that when I talk about this is a public performance, talk about my fund. Regulatorily, I have to disclose. I have chosen a particular date and shown it to you, just to tell you how the new fund manager with the new research team in Bombay with a particular thought process, which I've labeled as anti-mutual fund, has delivered very good value. I hope you're convinced about it. But it's also regulatorily required, and I'll be amiss if I don't do it, that I have to show you the disclosure on the fund since inception, right? Through those good time, bad time, good time, all of them put together in the regulatory format. So bear with me while I do that before I jump on to the next topic. So this is how the fund compared with the benchmark, right? So last 1 year, as you can see, the market has fallen 11%. This fund is 9.5, so it has delivered an alpha. The additional benchmark which SEBI stipulates is the Sensex for this fund, so it's delivered better. Last 3 years, it has delivered better. Last 5 years, also it has delivered. So this fund manager has improved. I told you, 5 years back, this fund was not doing so well. But now this new fund manager outperformance has wiped off some of the past sins, and over a history it's been able to beat the benchmark, though not the Sensex, which is the benchmark, but its benchmark it's beaten by a small amount. But since inception, it has given 17%, as I mentioned in the beginning. The Nifty, and from the same date, has delivered only 15.7. So clearly, the fund has, the recent good performance has gone and erased the history of underperformance, so that since inception also, this fund is now beating its benchmark. It has delivered an alpha of how much? 1.3% or 130 basis points. And if you now look at it from a rupees finance price, 10,000 rupees if you invested in this fund in the inception, today that would have become 1.67 lakhs, whereas Nifty would have given you 1.37 lakhs. That is 30,000 rupees clear alpha delivered into your hand, right? So that's the historical performance. I must admit, a few months ago, a few years ago, it wasn't so looking so good, because this new methodology and the success of the new fund management style has taken even the past performers. So the longer term investors also, who have already been invested, who are faithful with us, should also be happy looking at this performance, right? It's also regulatory required to show the other schemes managed by this fund manager. The fund manager's name is Mr. Rahul Bajal, and as you can see, he manages our equity hybrid fund, he manages the financial services opportunities sectoral fund, and the Sundaram services fund, which is also a sectoral fund. It's not the main agenda for me to talk about it, so I will leave it on for about 5 seconds here while I just grab a gulp of water. And hope you have read it, including the disclosure, the disclaimer at the bottom saying past performance may or may not be sustained in the future, and all other relevant factors are also given here. Now, this risk and reward, that was the regulatory performance disclosure. I would also like to disclose to you the risk and reward over the lifetime of the fund. So the rolling returns analysis I presented the titles are different, it's the same thing. So I've now included 5 years and 10 years, because the fund has been existing from 2002, right? So 18 years. Now you look at it here, what the recent performance has done and where it has helped to recover the past, and that you can see clearly here. I'll draw your attention to each of these. First, we are now looking at a real long-term number of periods. So you have 6,150 one-year periods, 5,400 two-year periods, 4,689 five-year periods, and 2,008. So you have a large base. So a good way to judge a fund. The average return, 1 year, it has beaten the benchmark. 21%. 3 years, it has beaten the benchmark. 5 years, it has beaten the benchmark. 10 years, it has not yet. So the average return is about 60 basis points less. But as you can see, it's caught up, and right out of the way up to 5 years, it has delivered better than benchmark performance, which is alpha. Minimum return wise, when the worst period lost 55, benchmark lost 56, better than benchmark. When 3 years, it lost 5.9% per annum, benchmark lost 5.6, not as good as benchmark. 5 years, not as good as benchmark, right? So clearly 10 years not. So while the average return has improved, the historical loss situations, right? They are historical, you can't recover them. So those remain on this track record, the worst returns of the fund. Maximum returns, the good times, well, clearly it has 1 year, it has delivered the best return is 22% more than the Nifty or the benchmark. It's 3 years, it's about 9%, 11% better. 5 years is 13% better, and in 10 years it is 2% better. So clearly, when the times are good and the going is good, this fund has over a period of time definitely been able to pick up the good things in the economy and deliver a better alpha. The more important thing from a risk perspective, positive return periods, that is capital protection. See again, on risk, this fund is not yet, the past underperformance is displaying itself. So 80% of the time only it has given positive return 1 year, Nifty has given 82, 2% better probability, right? 3 years, again Nifty is 98, this is 93, 5% better, 5% times better. 5 years, again 100 was 98. 10 years, it's on par, it's complete capital protection is there. So clearly that's the past. I already showed you the recent performance to give you a feel of this, right? And inflation waiting periods again, right? The fund has not been able, because of the history, right? Inflation waiting periods, the past. So over a period of time, as the fund continues to improve its performance, these numbers will improve. but it is my duty to demonstrate to you, because when you look at a fund, you also have to look at the long-term track record. Ultimately, you're buying a fund from the AMC. The AMC is responsible for the good and the bad, and you are going to evaluate our AMC also in that perspective. So it is good. I want to be good due diligence to tell you transparently and honestly how the fund has performed on a risk-reward matrix since inception. There's another way of looking at risk-reward. This I will not dwell in. Again, like I said, I'll do another deep dive class on how the financial markets, the financial industry looks at risk and reward. There are words like standard deviation, beta, sharp, all these ratios. I'm leaving the slide on for just 5-10 seconds more, so that those among you who are experienced stock market investors can look at it since inception, how has the various complicated, jargonized parameters that the industry uses. They are not useless. They are all very useful. They tell you the reward per unit of risk and all of that. But like I said, for me, this one reflects the fund since inception. And like I said, for about 9 years, it went through a very bad phase of underperformance. And those factors would show up in terms of a lifetime. But I'd like you to be fully aware and walk in with eyes open when you look at this fund, right? So that is that. Now, I come to the final part of my presentation, where I want to cover the reset, because if COVID is there in everybody's mind, it's entered our lives. The lockdown has made sure we sit at home. So new 5-letter word in our dictionary is COVID, correct? So what is the impact on this fund, on the portfolio and the performance? You should be aware, because as I would like you all, right, to look at it from my presentation today, definitely I want each one of you to make an investment in this fund. So this is formally, I would like to invite you to invest in this fund. But when you are now investing in this fund, I want to let you know that this COVID scenario, what are the key changes? I said, no, this is an anti-mutual fund, so it does things differently, but it does things dynamically and it's very responsive. So that responsiveness, I want to demonstrate to you as to what we're exactly doing and how has the performance in the COVID, post-COVID phase been. So this gives you a summary of what we are looking at the COVID and what we have done in the last paragraph. Just glimpse at it to get a sense of it. I'll just show it to you in a little more detail. So first, we talked about the theme concentration, top theme, top 2, top 3, top 4, right? So as you can see, just look at the change column. So what have we done? We have reduced concentration. So that's where the dynamism comes into play. So if you can see in the top theme, December we had 47%. What is the theme? Down below, banking and financials. In March, so the December to March tells you the COVID impact, because March was the severest. In May, there was a bounce back. So did we do any changes for the bounce back? So as you can see, no. We believed that no, this banking sector concentration we must bring down. So we dropped it 14% in that quarter, and we dropped it another 5.5% in the next quarter. The same in the second whole top 2 also, there's a drop. But as you can see, the drop is not as much. It means the second theme we haven't cut much. The third theme we have cut, because you can see from 12.8 down the drop is 13.5. So there is third theme we have cut, which is what here, the petroleum industry. And in the fourth theme, right, you've seen again it's 11.2, so we haven't cut. So clearly, overall concentration of the top 4 themes has come down in the last column on the right from 75.7% to 58.5%. So our reaction to COVID is to deconcentrate, or to use the traditional word, diversify a little bit. So this is a tactical diversification. When we see the market recover in a way that we are confident about the full recovery, we will take it back, right? But that's the fund manager's call. I can't tell you a date and time and when he do. What he is doing, he has full flexibility to act. I'm only demonstrating to you what we have done on the theme concentration. So this then is why we are currently. So from a theme perspective, the consumption, and I must tell you here, the banking, the kind of banks we have is that we have put the banks in the consumption. So that's why we are treating half of our thing is in consumption. So our conviction, the right hand side is number 1 conviction is on consumption. Number 2 is on a domestic cyclical recovery. And number 3 is on a government reforms. I left the slide here. It actually tells you the key stock overweights also. And there, I will not read out that. I will give it to you. And where are we negative? We have a weak outlook on global sectors because we believe the world is also going to see almost 5% negative GDP growth this year. And so we think that metals and all of that are going to get suffer from the global slowdown. And telecom is a key overweight. Pharma is a key overweight down. Right? That's the condition. Actually, that is all theme based. This is a sector based. I'll leave it on here first for you to understand. The Nifty sector, bank are 24%, we are only 18%. Software, they are 14, we are only 7. So clearly, we are clearly taking a call of being underweight on certain key sectors and overweight on some other sectors, right? That's the cash component. So what have we done? Yes, in this time of a market correction, in December we had 4% cash, in March we went up to 7.1, May is roughly the same. So clearly in an uncertain time, we have almost doubled our cash levels. So that's the second thing you must be aware of in terms of the current positioning of the fund. The third is the stock concentration. We talked about theme concentration and sectors, then we talked about cash, and now we talk about, so the top 10 stocks, which was 64%, have come down to 57. So clearly in two stages, first up to March and then to May, we have indeed brought down the stock concentration, and this as a response to this black swan COVID impact. So if I did not do that, then what's the point? Is simply sticking to saying I'm an anti-mutual fund. No, an anti-mutual fund means that I'm dynamic and I'm flexible, which is what I want to tell you. So similarly, in the top 3 stocks, the total from a 27%, 27.7, we have brought it down by almost 5 percentage points to 22.8. So clearly, a response to the COVID crisis has been to diversify a little bit more, increase cash a little bit more, and diversify the stock portfolio away from concentration, but remaining within 30 stocks. Another fund could have an advantage. We could do to take the stocks from 55 to 75, but we are going to remain within the 30, but we are reducing the concentration, and the lower weighted stocks were giving a higher weightage. Right? So that's another. So how has the performance been in this period crisis? So as those of you who study the markets will be aware, the table below shows you that December 31 was a pre-COVID level. There was no COVID. March 31, the full COVID impact had blasted, right? Because from February onwards, it started spreading the world started into lockdown, India went into lockdown, and the stock markets corrected heavily in March. So the December to March was the COVID impact in terms of the correction. But as you know, there's a V-shaped recovery expectation of the economy, which the markets have started to read into, and there is a slow recovery started. So June 30th, which is yesterday's data, tells you that. What have we done in these tables? I've compared the 1-year return as of December, as of March, as of June. So when you compare the 1-year return as of December with the 1-year return as of March, that drop will tell you the COVID impact. Right? And then when you compare the 1-year return as of March end to the 1-year return as of June, that will tell you the V-shaped recovery impact. So the actual numbers are given there. So the first thing, let's look at the first table in terms of returns. On a 1-year return in December, Nifty was 2.98, almost 3% better 1-year return than the Nifty, number one. In March 31, 2020, in the fall, we fell. Nifty fell more than us. And so we actually doubled almost our alpha from 3% to 5.4%. Like I said, alpha comes from protecting the downside as much as also from enhancing the upside. So we actually increased the alpha. And in June, we are still delivering a better 1-year return than the Nifty. Again, the loss protection as an alpha is 306 basis points or 3.06%. To then understand the way the move has happened, move to the table on the right, the 2-column table. So in the COVID impact, the Nifty lost 1-year return of 38.3%. That was the extent of the correction in the 1-year return. Our fund lost 35.8%. So the downside was brutal. It's not that we could deliver positive returns in that basis, but we lost less than the Nifty, which means in the downtrend, the fund has protected you by 2.4% versus the Nifty on the downside. However, in the V-shaped recovery, because clearly what happens is the V-shaped recovery, everything rises, but we are not yet confident that there's a upside. The Indian downturn is still happening, so we have moved to more cash, to more safety, to less concentration, as you saw in the previous 3 slides. Hence, we have not yet captured the upside. So while Nifty recovered 13%, we have also recovered, but only to the extent of 10.76%. So that gives you a summary of the current state of play, which the takeaway from this is that while the market has started rewarding risk again in this quick bounce back, we remain safety oriented. Hence, we haven't captured the upside as much. But we believe that our strategy will pay off in the times to come, because this bounce back of the market is attributable to a lot of the liquidity from FIIs. April to now, almost 30,000 crores of money FIIs have pumped into the market. So that money could easily reverse. So we have to wait and see whether the economic story supports it. But that being said, at this point in time, clearly, because of the FII flow support, large caps is the better space to be in terms of your portfolio, right? Or you should choose a multi-cap fund, which could easily switch on to more. But within the large cap space, we believe that a concentrated, focused, anti-mutual fund thought process large cap could deliver better value, because it can dynamically shift sector allocations, stock allocations, market cap weightages, overweight, underweight, overlaps with the benchmark, and a whole bunch of things to make sure that not only is the end result of your investment journey a very healthy, pleasant one over the next 3 to 5 years, but also that the road, that the journey itself will be less volatile than an overall market. With that belief, I hand over the fund with the final point of trying to tell you about the creative that this fund has had for the last 18 years and the thought process behind that fund, which fits into the creative. So what do you see in the creative? You see a bald-headed man, and you see a bullseye painted on the back of his head. So that tells you that this fund has an aim. It is a very focused fund. It is looking at the bullseye. However, there's an apple on top of that head. What is that conveying? That conveys the high risk, high reward nature of this fund. So while the bullseye explains to you the concentration and the focused approach of the fund, the green apple on top of the head points out to the anti-mutual fund thing that I've been talking about, which is that it will take bets, it will take concentrations, it will take flexibility and dynamism to keep figuring the market move so that it can change the portfolio dynamically. So why is that green apple on the top of the head reflective of this? Because it goes back to an English fable of the story of William Tell. So if you know about it, you know what I'm going to tell you. Otherwise, please go and Google it and look it up. So William Tell was an archer, right? So in order to practice the archery, his father, what he did, he told him, you have to be that accurate in your thing that I keep the apple on top of my head and you have to hit the apple. And the risk is that if your aim is slightly off, you're going to kill your father. So the apple there conveys that this fund is a high risk, high reward fund, right? And it is taking on that challenge to deliver alpha in the market. And all the presentation that I've showed you about the track record, about the risk reward equation tells you that this fund has been very successful in hitting that apple consistently over a lot of period, much better than a conventional mutual fund in the large cap space, which is the field of play for this fund. So I present to you, my friends, our anti-mutual fund, Sundaram Select Focus. Thank you. I do invite you to invest in this fund, speak to your advisor and distributor and speak about this. The fund is a moderately high risk fund, but as I mentioned, it's a risk I'm emphasizing, but we do hope that over a period of time, it will deliver the value and the reward, which is an adequate compensation for the risk. And I strongly recommend this as an addition to your portfolio, especially in these times when in terms of uncertainties, the large caps supported by FII flows and the safety element to these will generally do a better job of managing volatility than mid caps and small caps. And in that context, this is a fund which has proven itself to be better than a conventional diversified large cap fund in the marketplace. Right? Thank you very, very much. And in times of this COVID, let me reiterate to you, do stay home, stay safe, practice social distancing, and stay in close contact with your near and dear, telephonically or otherwise. Thank you very, very much, and all the very best. I'll request my team that if any of you has any questions, I'm happy to give a shot at answering them. Otherwise, thank you very much for your patient listening.
Hi, Sunil. We have a couple of questions.
Sure.
The first question is from Suvida Sawant. According to the IMF, the current increase in the Sensex is not real. It is kind of a bubble. Sensex may fall heavily. Is this true?
So I know the IMF said that, but I think that if you look at it in the context of the fact that earnings outlook is not going to be good, but liquidity is clearly coming. And if the liquidity is coming, it's because they see the future outlook for India beyond the near-term negative outlook. So I think the IMF is coming from a perspective that what if that liquidity goes away, the markets will correct, which is a statement of fact. Yes, if the liquidity goes away. So the word of a bubble, when does a bubble get formed? When you pump the gas in the air and the bubble goes up. So that's a very technical way of defining what's happening. The key question is this liquidity going to dry up? Is India going to become less attractive of that liquidity compared to other countries? The answer to both, I think, is in direct contrast to what the IMF says. I believe that there's today about $3.5 trillion of monetary stimulus pumped by various central bankers, which is lying only in money market mutual funds and cash. This is apart from the money. There is $13 trillion of monetary liquidity. Just the G4 countries are going to pump this year. So out of the 13 going to come, already about 3.5 trillion, 4 trillion is already lying in zero interest bearing money market mutual funds and cash worldwide. In the last 1 year, it's gone into gold, it's gone into fixed income. Small trickles have now started coming into equity. And if you take the average over a period of time, we expect about $2 trillion to find its way to equities internationally. Of that, India, I think that given the future outlook for India, there is a lot of this money which is longer term and not looking at the next 3 months, 6 months, or 1 year, where the COVID impact may be seen. For the longer term money, the correction that happened in March has presented a good buying opportunity and a significant portion of that money. So if you look at the flows across all emerging markets, April to date, India is the only emerging market which has got about $4 billion, 30,000 crores of money from FIIs, which has gone into the Indian stock market. So this $4 billion is nothing compared to the $13 trillion of liquidity. And I think that the whole negative feeling around China and a lot of advantages that India has vis-a-vis China, which will not get immediately activated. I would have read news items saying Vietnam is ahead. Yes, we do expect 1/3 of the China business that China is going to lose go to Vietnam. India is going to get about 10% right now. But I think there's a very good chance. That's why foreigners are betting on that. So I would say that what IMF says can happen if this liquidity is going to reverse. Now, I don't see that in a way where the world is going to be at minus 4.9% GDP growth. Any government or central banker is going to look at tightening liquidity or hiking interest rates. So in that easy liquidity scenario, I think India's positioning with respect to other emerging markets remains favorable. The crude price drop is a positive for the Indian economy, positive for the currency. So I don't have good reasons to believe that this FII flow is going to run away in a hurry. So in the absence of a liquidity bubble bursting FII outflow, I don't see any reason for the markets to collapse, right? So I think it is entirely that if it does turn that those liquidity dries up, which, like I said, our belief is that it is not going to happen, I don't see that threat to the market. And what is there? Is there no threat? There is a threat that COVID, we are now entering unlock phase 2. We are coming, the large parts of India are COVID free. But if there is a resurgence of the COVID, or if India-China situation, a war-like situation gets escalated, naturally foreigners will feel that India is risky in the short term and they may pull out money. So those imponderables always remain. But we can't build portfolios basis saying, will India go to war with China? Will the coronavirus reappear its ugly head in India, suddenly have to reintroduce lockdown from unlock 2? Those are all imponderables. But if you, even those imponderables, I would say, argues with me that whatever said and done, if you take a year's outlook to give all these problems a resolution, the India-China matter, COVID getting solved, a vaccine cure getting found, if you have a medium-term outlook as an equity market investor through mutual funds should be having, I don't see any reasons to worry. There could be corrections because of these two events, but that should not deter you from taking a 3-year call and staying invested or doing fresh investments in the stock.
Our next question is from Aditya Jain. Will the markets crash again due to the second wave of the pandemic?
I think I've just answered that question. If you can just hear what I said.
Sorry.
I think so. I think I've already answered that part, though it was not a part of the previous question. Thank you for the question, but I think if you want to read my answer, if you heard my answer, it covers that.
The third question is from Alok Sahu. What's the trailing PE ratio of this fund as on 30th June 2020?
I think that if you can reach out to your advisor, distributor, or to our website, that the 30th June is yesterday. So I don't think it's. I have the data readily to tell you the current trailing PE. Clearly, when you say trailing PE, you're talking about the last year. The last year, the stock market as a whole has delivered a negative EPS growth. So you're obviously looking at EPS. If the full year is down, it's going to be an exorbitant PE. But like I said, I would suggest that trailing PE is not really relevant from a future investment perspective. I think forward PEs are a better way to look at it. But like I said, if you want the trailing PE of it, I'm happy to have somebody answer it from our side, or you can drop us an email at our website or anything, and our team will respond.
This one's from Krishnan Iyer. What are the top 3 holdings now?
The current top 3 holdings of the fund, I don't know whether I have it here. The holding components. Yeah, just give me a minute. I have an Excel file where I have the holdings. Just one minute. I'll just, since you asked me the question. So the top 3 holdings right now are just a minute. Yeah, HDFC Bank, Bharti Airtel, and Reliance Industries. Can you see the screen?
Yes, sir.
Yeah, so I'm just going to highlight it in yellow. So these are our top 3 holdings: HDFC Bank, Bharti Airtel, and Reliance Industries. Yeah. So next question. Is there another?
Shouldn't we all invest in ETFs for large cap, as governments also trust only ETF for PF or NPS money?
No, like I showed you, this fund, well, the large cap category average I told you has demonstrated this, but that's basically I answered that in my presentation. But I think you see this fund has beaten the index on at least 50% of the time. Right? I'll just show you that slide once more. So in that context, I would say that the kind of alpha it generates. So I would actually take you through the rolling returns analysis which I showed you for the fund, right, over since inception. Not just reflective of this. So the fund actually, if you look at it over a period of time, maximum returns, right, is given in 1 year itself 20%. So there is a good chance to make good extra money. So just by putting in ETF, why would you want to do that? So I would say that there are times when funds underperform, but there are times when funds superly outperform. So I would say when the outperformance happens, you should be in a position to capture that. So I would say rather than blindly trusting in an index, and you know what happens in index, right? Like some time back, there was a bank which collapsed in India. I don't want to take a name, which was a part of the Nifty. So a fund manager could easily have chosen not to have it based on his outlook, but the Nifty ETF will necessarily have to buy that fund. So I would say that, I would still say that managing through a fund is a better bet because of the dynamism, and you can change over. The fund manager has the ability to buy non-Nifty stocks, right? The total out of 100 is there. 80% only is in large cap. So that means beyond top 100, you can take another 20%. So there's a lot of flexibility. When the economy starts reviving, easily you will see all the same funds beating the index easily. So I would say in a downturn time, it's looking this way. But in an upturn time, fund managers should be able to deliver alpha. I would still recommend that you go into a mutual fund. And I've already shown you how the advantage of this thought process of anti-mutual fund thought process has benefited this fund over a distinct period of time. I think I showed you that that level of outperformance of this fund relative to competition, right? So I think that you can still look at it from that perspective and not necessarily put all your weight behind an ETF just because government is diverting provident fund money into ETFs. The same governments, when you say that the alpha is getting generated, will allow their people to invest in the direct options of regular mutual funds also. So I think that I would still recommend that expertise of a fund manager will help you to deliver a better performance. Right? So I just want to show you the extra returns this fund has made over the category average. Okay, right? So I think that's something for you to bear in mind. So, yeah. Okay.
Next question is from Bharat. Is anti-MF similar to a contra fund?
I think not. So just because the word anti, I can see where you're coming from. But I would like to point out here some things here in terms of the, you take the call here. Banking and financial services, Nifty has 24%. It's our top weight, right? So it's not like we are contra to the market, right? So clearly, if we feel that the market Nifty has a high share of something which we are convinced we'll do. So it's not that we don't take contra bets. So the flexibility and the dynamism means that some parts of the fund are contra, which I would point out to in this. As to industrials and cyclicals, we are contra, because clearly in a negative GDP growth cycle we get affected. But we believe that proper stock selection there and the revival of the V-shaped recovery would benefit. So that's a contra call. So I would say it's a blend of pro and contra. So it's not a pure contra.
Our next question is from Akshat Mehta. Sir, can you please explain the concept of rolling returns?
So I already did it. You want to repeat it once more? The concept of rolling returns is that, as you have, I'll explain it with the detailed one. So if you see, the fund started in 2002. So since inception, 1 year investments on 1st July 2002, when the fund started, you could have made a 1 year investment. On 2nd July, you could have made one more investment, 1 year. 3rd July, you could have made. Like that, you could have made 6,000 1-year investments from that fund from there up to 1 year prior to today. So this tells you that over that 6,000 periods, how has the average return, minimum return, maximum return, number of times you lost capital, number of times you made more money than inflation. So that element is what is a rolling return, because it keeps that one year, every day a 1 year investment, every day a 3 year investment. How did it perform? So it's all what I like to call a bulletproof method of knowing how a fund has managed relative to its benchmark. So I'll suffice to say that much at this point in time. I'll promise, since you asked this question, like I said, we will hold a special rolling returns session where I will try and explain this concept in greater detail and take a lot of time to demonstrate how for mid caps, for small caps, for large caps, it's different. How a fund manager's alpha creation is different. It's a very good tool for judging risk and reward. So with that, I will leave it at this point in time, and await a session, a webinar on rolling returns sometimes.
This is the last question of the evening. It's from Santosh Singh. Is this the right time to invest lump sum?
Yes, I would say that though this fund, I'm talking about this particular fund in the large cap at this point in time. So I would say that in the large cap space, and when you're looking at funds like this, it is a good time to put lump sum. In mid caps and small caps, I would suggest a staggered investment through SIP or SIP, because I see that the next 1 year is going to be volatile. The market is going to be held up by this international liquidity rolling into India, which is largely going to be in the top 100 stocks. So the large caps will not only be less volatile at this point of time, when there's a lot of foreign money coming in, it can also give you good positive returns, as you are seeing from the index and the recovery, like I showed you the bounce back that has happened, right? Uh, 1 minute. I showed you the COVID impact. 1 minute. I'll just show you the slide. So as you can see, there has been a strong bounce back in the market, right, of 13% in the large cap space. So mid caps also have got a bounce back, but the volatility, because the news flow on the mid caps in terms of smaller companies getting affected, you've seen the earnings growth of mid and small cap is definitely dropped far more than that of large caps. Definitely, they are more vulnerable to the Indian economy's slowdown this year. So there is going to be volatility. There is fund flow into mid and small caps from mutual fund side coming and supporting, but it's not as much as the FII funds can come in. So in that context, one, right, the upside will come from greater liquidity going into the market. So if you recollect my previous slide, which I showed you on why stock markets deliver returns, right? So I think that's where I'll use that to explain this to you, right? So 1 minute, just bear with me while I take that slide. Okay? So if you see the aspect of a stock market, how it delivers return, right? Right? So if you look at it, right, there is a earnings growth, which is going to be negative now. There is a valuation, earning growth expectation, which is also negative now. What's holding the market? Rising demand for stocks. Where is the demand coming from? It's FIS. Where will that demand go? It's large caps. So in a situation where earnings growth and earnings growth expectations both are not supportive, the demand for stocks comes from a set of players who are going to largely put their money in large caps. Hence, in such a negative scenario, the downturn in large caps will be less than in mid caps, because there the earnings growth and the expectations are far lower, and there is not that much liquidity supporting them in the short run. But as the V-shaped recovery starts coming into play, which I don't know will happen now, 3 months, 6 months, 9 months, we'll wait and see. That time the whole situation will reverse, and large mid caps and small caps will benefit more than large caps at that time. But the timing of that is uncertain, and the road to that is also uncertain. So there is volatility. So I would say in mid and small caps, you should be in an SIP mode, so that you buy more when the correction is more, so that when ultimately it goes up, you would have made much more money by buying when the price was low. Right? Rupee cost averaging explained in several terms. So I would say that large caps give you both an upside potential and a downside protection potential, better than mid and small caps for the next 1 year time frame. So I would suggest that in your allocation, putting lump sums is not a bad idea. But at any point in time, SIPs are always something that based on your income pattern. If you're a salaried person, if you're a monthly rental who's dependent on person, right, then your income as it comes you deploy, then SIPs are wonderful.
So we have no further questions.
Good, right. So thank you very much, all of you, for a very engaging question and answer session. All the very best, and come to you soon with our next in our Wisecast webinar series. As I said, we are going to be shortly launching something called a deep dive, which is going to go into various concepts, various types of things, which is not fund related. So basically, we are going to do 2-3 types of things. So one is the economy markets update, which we did through our e.m.i. That is one thread we will maintain. Second is where we will talk on our key products which are having clear positioning, to explain those to you so you can make an intelligent decision about whether to invest in those or not. That's another stream. The third stream that we are planning to launch something called deep dive, where we will try and explain fundamental market concepts, or in terms of large caps, mid caps, small caps, asset allocation, and all of these for a period of time we'll try and cover. So do look out for the Wisecast series from Sundaram, and do subscribe to our channel, and and participate in these through Twitter, Facebook, or through YouTube, as the case may be. I think a version of this PPT that we spoke will be shortly so up on YouTube for you to go through it in detail, because I know attention span over such a long time would have been difficult. So we can go through it again to understand the concepts, and happy for our team and ourselves to answer any questions which you can reach us through our website. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.